Alright, hey everyone, this is DayTraderRockStar, and this is the second part of the HPS watch list video. The first one I kind of put out as a review of a lot of the patterns we've been watching this past month of May. You might have seen this. I posted this during the day. If not, it'll be a separate video that you probably will see because it'll be posted along with this one instead of adding it to this one, because this one is a private one. Basically, in case you don't want to go back and read that other one, I want to kind of go over some of the important details because we did talk about the markets a little and a couple of good setups. And basically, going into next week, the first week of June, we leave off today on a very bullish note. The market's breaking out to new highs. Everything looks golden. Even some good volume today, too. And, we're going into next week and we have an important ECB meeting, and from that they're expected to have a rate cut and maybe even a stimulus program announced. And this is, of course, definitely going to be a market mover, and a lot of people would think this might be a positive market event because it has been a positive event here for the markets since we've had our stimulus, and so they would expect to see the same. But things are probably they're never the same. They're never the same. So there's been a lot of talk about this. This is widely expected. So we've set ourselves up into a situation where we could see selling off of this news, and kind of a sell the news, kind of a blow off. I mean, the market has pushed higher. We're extended on the daily. We're extended on the 60. And one thing I've learned over close to 20 years of trading is what you think is not always what the market's going to do. So even though this becomes an area where it's saying, wow, when is this market going to pull back? I always look for an event. I think there's a good event this week on Thursday, and then we have our jobs number on Friday. But before that, I mean, there's no real timing here on the market. Do we sell off going into this? I'm sure the volatility is going to pick up a little going into the midweek, and we might see some selling before this. Maybe not. Maybe we actually rally into it. Maybe we pop into it. But I'll tell you one thing. I have a lot of shorts on this list I want to bring to you, and I'm going to start concentrating on those a little bit more now. And I actually would like to probably, if everything plays out according to what I could maybe see is a kind of a blow off into this ECB meeting, maybe try to take a couple of these shorts because they're very extended, and as we do well picking up good quality names, buying into the weakness, you want to kind of do the same thing. You want to try to short into that strength or sell into that strength. So if we do have a positive reaction off of some of this news this week, I want to try to take that and try to initiate a couple shorts into that. All right. There's not much else you could talk about here. The daily and the 60s extended. We do have a trend line above us. There'll be different trend lines that people will be posting here. Mine's just a kind of a crude one that from the last two really good pivots in the market brings us up to a level which it looks like it's above 1950 if we're going to get back up to that zone, and that's a rise in trend line. So this, if the price takes its time, that line will continue to rise. So the daily again extended, the 60 extended, and we left off today with the 5 minutes. So maybe see a little selling on the Monday to start the morning off, but again, try not to try to call a top here. Now, going into stocks for next week, we had such a great last couple of weeks because the patterns were coming up, and I always talk about seeing stocks kind of rotate together. Certain patterns will play out in the market. Sometimes we'll have flags. Sometimes we'll have just good channels. Sometimes we'll have channel breakout rotations. In this case, we've started seeing a lot of the lane divergence, momentum shifts on quality names, and we kind of focused on that. So I want to continue with a little more education on towards that effect, because I had a couple questions about the lane divergence, and you can see how well it works. I mean, you could look back at the trades. So I wanted to really kind of go back over that and kind of give you a little more of in-depth what I look for when I'm looking at the stochastic. So let's just jump into that right now for just a few minutes. All right, now remember, if you don't have, you could watch this video at large screen format, so you could roll your mouse over it until you see that screen, and you could click it to large screen in case that somebody's in. These are some of my educational charts that I have just based on some webinars and stuff, and this is just an example of some of the indicator or some of the we'll say some of the patterns I'm looking for in the stochastics. Not so much the price, but the relationship between the stochastics and the price. These are my main two things. The stochastics, of course, are like the base and the groundwork of all the things I work off of. So I always want to have that set it up in one direction or another, and understand that overall is my, that's the tide going in or tide going out, and I want to work with that. We kind of understand that the stochastics are a momentum indicator. You have buying momentum and selling momentum, but basically it's momentum. You could have momentum as equal on both sides. You can have fast momentum up and fast momentum down. You can even have slow or choppy momentum. You can have embedded momentum, which is, because this only goes to a 0 and to 100. Once you get up to that 100 level and you're still seeing that upside or the underneath momentum buying pressure into the stock, you're not going to get a bigger read on this, so you're going to start to flatten out there, and that tells you something in itself. So all these little patterns that play out in stochastics mean something. And one of the main things is the divergence play, and that's what the stochastics were originally developed for. It's the measure the momentum of the price, and when that momentum shifts, the price shifts late afterwards. So the momentum becomes a leading indicator instead of a lagging indicator. And we actually see that price, and I actually have an example here just on the S&P. This is actually on the daily chart, and this works on multiple time frames. You could find this on any time frame. Of course, it'll play out on a longer duration, the longer the time frame. Well, basically, you're following the momentum. The market here kind of selling off here, and the momentum here drifting back down into an oversold level. We got oversold here. You can see right here, and we kind of got a little bounce, and we failed, and we pushed back and we made new lows. But the stochastics didn't make didn't go back down towards the recent low. We held above that. If drew a straight line here, this would have an upward slant to it, where the lower lows here would have a downward slant. And that's the kind of momentum change you're seeing. And actually that confirming crossover is really what you want to wait for. You want to wait for that secondary crossover, because you could get close to seeing that. You can say, well, we're making new lows, but we haven't made new lows yet. But until you see that crossover, that's kind of the little safety net that you want to have. You want to make sure that crossover happens. When you see that crossover, you usually start to see the action come into stock. And again, just like everything else, these are, when you're talking about the daily, you're talking about a daily time frame. It could be everything from, a few days to a couple weeks, versus the 60, which could be a couple hours to a couple days. And then the 5 minute is, basically a few minutes to, a little bit longer. So each one has its own time parameters on it. So we're looking at that overbought, the oversold, the divergences, the embedded stochastics, and even some of the other things that we look for is like a coil stochastic. That kind of develops a longer term trend, but understanding when that trend comes to an end, the coil kind of comes to a compressed area, and you look for that explosive move out. And we see that on both the upside and the downside. And I'll give you an example of that real fast, because we've been seeing some good ones. So let me get that up for you. All right, here is the coil stochastic, and basically it's this, on a buy trigger or a pullback phase of a stock. And again, everything has to be taken with a good stock. These work the best when you have a recognizable name, or kind of a good quality name behind it. This one, General Mills, is a no-brainer. And again, you want to recognize a channel with that stochastic. It's really going to kind of coil up, and the channel is going to stay in an extended little trend, because the coil here is showing that weakness. We're not making new highs on the downward coil here. Basically, we just continue to make lower highs. And once you start to establish a range of that channel, you want to pretty much kind of gauge the oversold level and closest to the lower channel you can. Again, this is something that you're not going to get the exact penny on this, but you're going to get a good, this is your timing indicator. When this gets compressed, then you're pretty much ready to make a move. And from that level, we have a nice breakout of that. We usually see this breakout lead to this breakout. So very nice example on that. And there was a short example recently too. All right, here you have the, this was in Southern, and this is actually a great wedge pattern that identified before the breakdown. You could actually see it was up here towards the top part of that channel line. We kind of got real coiled up. What was interesting about this was an identical pattern, basically to identically set up to the day. It was 5 days difference between how this whole pattern played out and how it played out the year later. Now this comes back to one of the simplest rules I always talk about in trading is concept of having the wind in your sails. Going against the tide is always a harder thing to do than to go with the tide. And you could use any analogy out there, but basically, the momentum here shifting from overbought and over to sold, and you see how many times it works out. So there's a great probability when you get overbought, the next move is going to be a little pullback, and the same thing when you get oversold. So you can just look back at any chart. A standard stochastic settings here, 14.33. What I use, a lot of people use, you could use 14.43. You'll see that as a default on a lot of things. You can experiment with them, but basically you're going to see that 14.3 parameters here work like a charm. And that's, again, a key for your trade. If you're going to think about taking a short, you most likely want to have that daily stochastic here starting not to be embedded to the upside, showing great strength, but starting to break down and maybe starting to show the momentum here picking up to the downside. And the same thing, you don't want to be going short when you're starting to get oversold. Now, when you can combine these setups, the stochastics, with the other underlying indicators, especially the reversal candles, that's a golden ticket right there. And that's why we really use a lot of candlesticks, a lot of hammers, a lot of engulfing patterns, piercing lines, real reversal things. We try to capture these pivot areas. So, again, just remember, easy rule to go by is just to look at the stochastics on the daily. Break it down to the 60-minute time frame to really tighten up your entries and exits, which I use the 60 as my exit time frame for shorter term trades. And the multiple time frames is the combination of what you really want to use. That's what we just call multiple time frames. You get your daily set up, you get your 60-minute set up, and you try to even break it down to the 5-minute, and you have your great entry there. And then you can take it off based off the time frame you want to be in the trade. Now, the multiple time frames work good on multiple stocks. I mean, the stochastic divergence, or the lane divergence, works great on the S&P. And you could actually see this is the S&P cash chart here, and this is on the 60-minute time frame. And again, the lower high on the stochastics, the lower low on the price. You can look back. It does not happen often, so when you do have it happen in front of you, and you actually get I can identify it for you. Really take notice of it, because it's usually one of the better indicators of a. Remember, this is a leading indicator. You're not chasing a stock here. You're recognizing that momentum has shifted before the price, and then usually you add that to the recognizable pattern, which is a flag. You have the lower trend line. You're down there, and again, you're oversold. And probably on the 60-minute time frame, this is probably oversold, which it is. But if this was even on the daily, then you bring it back to the 60. There's another example of that kind of divergence playing out. This kind of downward motion when we had an oversold level lining up with this low, a higher low lining up with this lower low, and from that point on, you have your trade to the upside. In these cases, very easy just to put your stop in at that recent low. That's where you really want to put the recent low. On rare occasions, you might make a third divergence, meaning that normally that lane divergence is a low and a lower low and a higher low. Sometimes we actually could go into 3 higher lows and 3 lower lows, but the overall move after that is typically a strong one back up. But you don't see it that often, but when you do see it, I try to give that tip to you when we see it. So again, when you're trading an individual stock, very easy to tune into the S&P, the overall general market that your stock or whatever you're trading is trading off of, and see if that divergence is playing out and see which way the direction is here. It doesn't have to, there's going to be cases where you might be in a stock showing relative strength, the market will be going down, your stock will be going up, and that's another indication all on its own. You'll be able to identify that. That's a relative strength. All right, let's continue on. All right, the other way you could read into stochastic sometimes is what we call the price stochastic divergence. And this one I call it the channel stochastic divergence, but it's basically a price stochastic divergence, where again you're following the stochastics as just kind of a nice little rhythm, overbought to oversold, oversold to overbought. And as this, as the market here is trending, you can identify a trend, you should continue to see that each lower low or each low on the stochastics will bring a new low on the price, as long as you're staying in that channel. So it's important to identify a channel using this technique, because what you're looking for is, the stochastics get oversold again, but the price to maintain or stay above the recent low. And once you see that, that's giving you a little clue of the potential move back up. The strength here, momentum is shifting. We're not taking out any more lows here, so the price is basically ready to push back up. And from that point on, you could establish a trade and kind of plan out a trade in this zone. Remember, once you establish on the daily, you could break it down to 60, to, just to get your timing a little bit better, and take it from there. All right, looking forward into the next couple weeks, because the market has been so bullish, and we're taking a look at a chart right now, because this is another what I call playbook play or trade based off the stochastics. And sure, we're talking a little education on stochastics. We'll go into what we call a channel breakout stochastic rotation. And this is, first of all, you have a classic 1-2-3 pattern. And one of the better setups is what we call the 1-2 combinations, where the stochastics come down to that fourth level, and you get oversold at the same time. So identify a 1-2-3, trade 4 with an oversold level. Once you eventually follow this trade and it breaks out, one of the next best trades is waiting for that stochastic indicator to rotate all the way back down into an oversold level. This gives the first of all, this gives your chance for the stock price to come back here and kind of base out and give us the first indication of a new channel or a new trend. And you can actually see there was an underlying trend line here that worked out perfectly. This is what we call the next marks the spot type of trade too. So whenever you have that channel breakout, it comes back, you have the underlying trend line. That's usually one of the best trading setups out there. But you don't even need that underlying trend line. This is just a timing trade. What you're basically doing is you're looking at this pivot area. Now you're looking at a new pivot because you've broken this downtrend, and you're going to look for this to build back up and eventually put a new channel up here. And one more time, we'll just take a look at a Coil Stochastic where we have that series of lower lows. The underlying trend line is very important. Timing the two as you get kind of compressed down here. You just want to get take your entry down closer to this trend line as you finally coiled up, knowing that there's a big move coming, and that's your big move. So just I'll post these charts on Day Trading Radio, so you can actually keep them for reference. All right, so let's start off with taking a look at this week's, this upcoming week's watch list. The first week of June. Remember, the week is filled with some great news items. We're gonna have the ECB again. I can't talk about it enough, and the jobs report next week. So very busy week, and understandable. You can understand it might get a little volatile, and we might actually see a short-term top in the market if that plays out. During the week, someone came to me and asked me about U.S. Steel, and it just came out, a blog came out talking about a short, and it got hit. The next day, it pushed back up, and someone asked me about it. How does it look down here? And technically, it looked oversold on the daily, but I felt that because of that recent blog came out, it was increased volume on that. It was overhanging the stock, and we had that initial bounce. So at the time we were looking at the initial bounce, I was watching that 60-minute chart. And I wanted to say, at this point where he mentioned this, he goes, what do you like U.S. Steel here? And I said, well, the stochastics are starting to approach that 60-minute time frame. Let's let this thing rotate back one more time and see how it acts, because that news is still overhanging. And this is probably just traders trading this. But anyway, you can see what happened. We actually gapped down and pushed right back down to the trend line. And look at how that trend line came into play. Now, I'm not I don't really like this trade too much, but it is on that daily trend line, and that 60-minute time frame is oversold. So that condition is here. It is here. It seems to be flatlining here, which is typically a negative scenario, because if you start to see, if you have 3 periods of negative action and you start to embed itself down here, there's usually more downside. Not much, too much more. It's a very slow-moving stock, but I could easily see more downside on this. I just don't care to trade USD. I think there's other better setups out there. But remember, the key here was just to mention that 60-minute time frame. Same thing. If you're looking at a stock and you see that 60 getting back into overbought level, especially in a downtrend, most likely that trend is going to continue, especially if the stock suffers from stock rot, which is my term from a stock that just basically has that downward trending pattern to it if you go out a year. This one not so much, because actually it had its year last year in 2013. It actually did move up pretty good, but looks kind of weak now, and I'm just not interested in it.